Look, I need to show you something that's happening right now in the silver market. And I'm not talking about some theoretical scenario or something that might happen years from now. I'm talking about a situation that's unfolding as we speak. And if you have any savings sitting in cash, you need to understand what this means for you. Let me start with a question. When was the last time you saw industrial users panic buying a commodity? Not investors, not speculators, but the actual companies that need this metal to manufacture products. The companies that use silver in solar panels, in electronics, in medical devices, in water purification systems. These aren't people who care about price charts or technical analysis. They care about one thing. Can we get the physical metal we need to keep our factories running? And right now, they're scrambling. They're paying premiums they've never paid before. They're locking in supply contracts at prices that would have seemed insane just months ago. And here's what should terrify you. They're doing this because they know something. They know that the silver that's supposed to be available isn't actually there. Let me explain what I mean. The silver market operates on two levels. There's the paper market, where contracts trade on exchanges like the COMEX. Billions of dollars worth of silver changes hands every day on paper. Then there's the physical market, where actual bars and coins move from refineries to vaults to end users. And these two markets are supposed to be connected. The paper price is supposed to reflect the physical reality. But something broke. The connection between these two markets is fracturing, and when I show you the evidence, you'll understand why industrial users are in panic mode. Start with the most basic metric, the ratio between paper silver and physical silver. For every ounce of physical silver that actually exists in COMEX warehouses, there are over 400 ounces of paper claims on that silver. Think about that. If just a tiny fraction of the people holding paper silver decided they wanted physical delivery, the entire system would collapse. It's like a bank that has 400 depositors for every dollar in the vault. Now you might say, well, that's always been the case. The paper market has always been leveraged. And you'd be right. But here's what's different now. People are actually asking for delivery, in significant numbers, and the warehouses are draining. Let me give you the numbers. COMEX silver inventories have dropped by over 30% in the past year. That's not a small move. That's not normal volatility. That's a structural shift. And it's accelerating. We're seeing drawdowns of millions of ounces per month. At this rate, at current demand levels, we're looking at a potential inventory crisis within months, not years. But it gets worse, because COMEX isn't the only place where silver is stored. There's the London Bullion Market Association, the LBMA. This is where the big institutional players trade: central banks, sovereign wealth funds, major investment houses, and their inventories are dropping too. We're seeing outflows from London vaults that haven't been seen since the last major silver squeeze. Now let me tell you what's driving this demand, because it's not just investors buying coins and bars. That's part of it, sure. But the real story is industrial demand, and this is where it gets really interesting. Solar panel manufacturers are the biggest consumers of silver in the world. Each panel requires about 20 grams of silver, and global solar installations are exploding. We're not talking about modest growth. We're talking about exponential expansion driven by government mandates, climate policies, and the simple economics of renewable energy becoming cheaper than fossil fuels. China alone is installing more solar capacity in a single year than the entire world installed just a decade ago. India is ramping up massive solar projects. Europe is accelerating its green transition. The United States is pouring hundreds of billions into renewable energy infrastructure. And every single one of these solar panels needs silver. But here's the problem. Silver mine production is basically flat. We're not finding major new deposits. The existing mines are mature. Production costs are rising. And the amount of silver that comes out of the ground each year is barely keeping pace with industrial demand, let alone investment demand. Let me put this in perspective. Annual silver mine production is around 800 million ounces. Industrial demand alone is consuming over 600 million ounces. That leaves 200 million ounces for everything else. Investment demand, jewelry, silverware. And here's the kicker. Investment demand has been running at over 300 million ounces per year. Do the math. We have a deficit, a structural deficit. and it's being filled by above-ground inventories. The silver that's sitting in vaults. The silver that's supposed to be backing all those paper contracts. That silver is being drawn down to meet physical demand. Now, let me tell you about something that happened that most people missed. A few months ago, a major solar panel manufacturer in Asia tried to secure a large silver supply contract. They went to their usual suppliers, and they were told there would be delays, not because of logistics, not because of refining capacity, but because the physical metal wasn't available at the quoted price. The supplier said, "We can get you the silver, but you're going to have to pay a premium over the spot price." And not a small premium. We're talking about premiums of 15%, 20%, sometimes more. For industrial users, this is unprecedented. They're used to paying spot price, maybe a small fabrication fee, but now they're paying premiums that look like retail investor premiums. What does that tell you? It tells you that the spot price, the price you see quoted on financial websites, the price that trades on the COMEX, is not the real price. The real price is what you have to pay to get physical metal delivered to your facility, and that price is significantly higher. This is called backwardation. It's when the spot price is lower than the forward price, or when physical metal trades at a premium to paper contracts. In a normal market, this doesn't happen. In a normal market, you can always get physical delivery at the spot price, plus a small premium for logistics. But we're not in a normal market anymore. Let me tell you what happened in 2011. Silver hit nearly $50 an ounce. It was a massive run-up, driven by investment demand, industrial demand, and concerns about currency debasement. Then it crashed. It fell all the way back to $14 over the next few years. And everyone said, "See, silver is too volatile. It's not a real store of value." But here's what they missed. The fundamentals that drove silver to $50 in 2011 were nothing compared to what we're seeing now. Back then, solar demand was a fraction of what it is today. Electric vehicle production was negligible. 5G infrastructure didn't exist. The green energy transition was a concept, not a global mandate backed by trillions in government spending. And yet, silver went to $50. So what happens when you have fundamentals that are 10 times stronger, inventories that are a fraction of what they were, and a supply deficit that's structural rather than temporary? Let me show you what the smart money is doing. Central banks have been accumulating gold for years. Everyone knows that. But what people don't realize is that silver is starting to show up on central bank balance sheets too. Not in huge quantities yet, but the trend is there. Why would a central bank buy silver? Because they understand what's coming. Sovereign wealth funds are taking positions in physical silver, not paper ETFs. Physical metal. They're building vaults. They're securing supply chains. They're treating silver like a strategic resource, not just an investment. And then there are the billionaires, the guys who have access to information you and I will never see. They're buying silver mining companies. They're funding exploration projects. They're building positions in physical metal. Why? Because they can do the math. They can see the supply-demand imbalance. And they know that when this thing breaks, it's going to break hard. Now let me talk about something that most people don't understand about silver. It's not just a precious metal. It's not just an industrial metal. It's both. And that dual nature creates a unique dynamic. When you buy gold, you're buying a monetary metal. Gold's primary use is as a store of value. Industrial demand for gold is relatively small, so gold's price is driven primarily by monetary factors: currency debasement, inflation, geopolitical risk, financial system instability. But silver is different. Silver has massive industrial demand. Over 50% of silver demand comes from industrial applications. So silver's price is influenced by both monetary factors and industrial factors. And right now, both of those factors are screaming higher prices. On the monetary side, you have everything that's driving gold: currency debasement, central banks printing money, government debt spiraling out of control, inflation eating away at purchasing power, geopolitical tensions, de-dollarization. All of these factors make people want to hold real assets instead of paper currency. But on the industrial side, you have something even more powerful. You have a green energy transition that requires massive amounts of silver. You have electric vehicles that use 3 times more silver than traditional cars. You have 5G infrastructure that needs silver for its components. You have medical applications that are expanding. You have water purification systems that use silver. This industrial demand isn't optional. It's not like jewelry demand that can decline if prices get too high. Solar panel manufacturers can't just decide not to use silver. Electric vehicle makers can't eliminate silver from their vehicles. This demand is structural, it's growing, and it's not price sensitive in the way that investment demand is. Let me give you an example. A solar panel manufacturer might use $20 worth of silver in a panel that sells for $300. If the price of silver doubles, their cost goes up by $20. That's not going to stop them from making solar panels. They'll just pass that cost on to the customer, or absorb it in their margins. The demand for solar panels is driven by government mandates, electricity costs, and climate policies, not by the price of silver. So you have this situation where industrial users will pay whatever they have to pay to get the silver they need. And that creates a floor under the price, a floor that keeps rising as inventories decline and supply becomes tighter. Now let me tell you about the refineries, because this is where you can see the stress in the system. Silver refineries are running at capacity. They're working overtime. They're struggling to keep up with demand. And they're telling their customers that lead times are extending. It used to be that if you wanted to buy a large quantity of silver bars, you could get delivery in a few weeks. Now, you're looking at months, and that's if you're willing to pay the premium. If you want spot price, you might be waiting even longer, or you might not get delivery at all. This is not normal. This is not how commodity markets are supposed to work. In a normal market, if demand increases, price rises until supply and demand balance. But in the silver market, the paper price isn't rising fast enough to reflect the physical shortage. Why? Because the paper market is so large and so leveraged that it's suppressing the price signal. Think about it. If you're a big bank trading silver futures, you don't care about physical delivery. You're just trading contracts. You can sell silver you don't have, buy it back later, and pocket the difference. You're not constrained by physical inventory, so you can keep selling paper silver, keeping the price down, even as physical inventories drain. But this can't last forever. Eventually, the physical market and the paper market have to reconcile, and when they do, the price adjustment is going to be violent. Let me tell you what happened in the nickel market. In early 2022, nickel prices exploded. They went from $25,000 per ton to over $100,000 per ton in a matter of days. Trading was halted. Contracts were canceled. The entire market broke down. Why? Because a major player had a massive short position, and when they tried to cover it, there wasn't enough physical nickel available. Now, nickel is a much smaller market than silver, but the dynamics are similar. You have a paper market that's disconnected from physical reality. You have short positions that are larger than available supply. And you have industrial users who need the physical metal. The difference is that silver is even more critical. Nickel is used in stainless steel and batteries. Important, yes. But silver is used in solar panels, electronics, medical devices, water purification, and dozens of other applications. The economic impact of a silver shortage would be far greater than a nickel shortage. And here's the thing. The people who are supposed to be managing this risk, the regulators, the exchanges, they're not prepared. They're operating under the assumption that the paper market and the physical market will always stay connected. They're assuming that there will always be enough physical silver to satisfy delivery demands. But that assumption is being tested right now. Quick aside here, if you're sitting on significant savings, especially if you have retirement accounts with 6 figures or more, you might want to look into how physical precious metals can fit into your wealth protection strategy. I put together a free guide on gold IRAs and how they work. It's in the description. Covers the mechanics, the tax implications, the logistics. Worth checking out if you're thinking about diversifying out of paper assets. No pressure, just information. Anyway, back to what's happening in the silver market. Because there's another factor we need to talk about. The silver-gold ratio. Historically, silver and gold have traded at a ratio of about 15 to 1. meaning it takes 15 ounces of silver to buy 1 ounce of gold. This ratio has held for thousands of years. It's based on the relative abundance of the metals in the Earth's crust. But right now, the ratio is around 85 to 1. Silver is historically cheap relative to gold, and this is happening at a time when silver's industrial demand is exploding, while gold's industrial demand remains minimal. What does this tell you? It tells you that silver is mispriced. Dramatically mispriced. Either gold needs to fall, or silver needs to rise, or both need to move to bring the ratio back to historical norms. And given the fundamentals, given the supply-demand dynamics, given the industrial demand trajectory, which direction do you think that adjustment is going to go? Let me tell you about the investment demand side. Because while industrial demand is the big story, investment demand is the accelerant. When investors start piling into silver, when they start demanding physical delivery, that's when the market breaks. We're already seeing signs of this. Silver ETF holdings have been volatile, but physical coin and bar demand has been surging. Mints around the world are reporting record sales. The US Mint, the Royal Canadian Mint, the Perth Mint, they're all struggling to keep up with demand. And this is retail demand. Small investors buying coins and bars. Imagine what happens when institutional investors start allocating to physical silver, when pension funds decide they need exposure, when sovereign wealth funds start building positions, when billionaires start treating silver like a strategic asset. The available supply would be absorbed in weeks, maybe days, and the price would have to rise to a level that would make current prices look absurd. Now, let me address the counter-argument. Some people say, silver has been a terrible investment for years. It peaked in 2011 and never recovered. Why would this time be different? Fair question. Let me answer it. First, the fundamentals are completely different. In 2011, silver's run-up was driven primarily by investment demand and monetary concerns. Industrial demand was growing, but it wasn't the dominant factor. Today, industrial demand is the story. And it's not speculative demand that can disappear overnight. It's structural demand backed by government mandates and technological trends. Second, the supply situation is different. In 2011, there were large above-ground inventories. Mines could ramp up production. Recycling could increase. Today, inventories are depleted. Mines are mature. Recycling rates are already high. There's no easy supply response. Third, the monetary environment is different. In 2011, central banks could still raise interest rates to fight inflation. They could tighten monetary policy. Today, government debt levels are so high that aggressive rate hikes would cause a debt crisis. Central banks are trapped. They have to keep printing money, keep debasing currencies, even as inflation persists. Fourth, the geopolitical environment is different. In 2011, the world was relatively stable. Today, we have major power competition. We have supply chain fragmentation. We have countries trying to reduce dependence on the dollar. We have resource nationalism. All of these factors favor hard assets over paper currencies. So yes, silver has been frustrating for investors who bought at the peak in 2011. But the setup today is fundamentally different, and the potential upside is much larger. Let me talk about what a supply crisis would actually look like, because I don't think most people understand the implications. Imagine you're a solar panel manufacturer. You have contracts to deliver panels. You have factories running. You have employees to pay. And suddenly you can't get silver. Or you can get it, but only at prices that are double or triple what you budgeted. What do? You can't just stop production. You have contractual obligations. So you pay whatever you have to pay. And you pass those costs on to your customers. And suddenly, solar panel prices are spiking, and projects are being delayed, and the green energy transition is hitting a bottleneck. Or imagine you're an electronics manufacturer. You make smartphones, computers, medical devices. All of them require silver, and your suppliers are telling you there are delays, or they're demanding premiums. What do? You start hoarding. You start building inventory. You start securing long-term supply contracts at whatever price you can lock in. Because you know that if you can't get silver, your entire production line shuts down. And this behavior, this panic buying, this hoarding, it creates a feedback loop. It accelerates the drawdown of inventories. It pushes prices higher. It creates more panic. And suddenly, you have a full-blown supply crisis. This is not theoretical. This has happened in other commodity markets. It happened with palladium a few years ago. It happened with nickel. It happened with lithium. And it's starting to happen with silver. The question is not if it will happen. The question is when, and how severe it will be. Now let me talk about what this means for you, for your savings, for your financial security. If you have money sitting in a bank account, earning minimal interest, that money is losing purchasing power every day. Inflation is eating away at it. The official inflation numbers might say 3% or 4%, but your real-world experience is probably much higher. Food costs, energy costs, housing costs, they're all rising faster than your savings are growing. And if a silver supply crisis hits, if industrial users start panic buying, if investors start demanding physical delivery, the price of silver is going to explode. And when that happens, everything that requires silver is going to get more expensive. Solar panels, electronics, medical devices. The inflation you're experiencing now will accelerate. But if you own physical silver, you're protected. You're holding an asset that's rising in value as everything else gets more expensive. You're preserving your purchasing power. You're maintaining your standard of living. And here's the key word: physical. Not paper silver, not ETFs, not mining stocks. Physical metal that you can hold in your hand. Because when the paper market breaks, when the disconnect between paper and physical becomes undeniable, the only thing that will matter is who actually has the metal. Let me tell you about the difference between paper silver and physical silver. When you buy a silver ETF, you're buying shares in a fund that claims to hold silver. But do you actually own that silver? Can you take delivery of it? In most cases, no. You own a claim on silver, a piece of paper that says you're entitled to a certain amount of silver. But if everyone who owns that paper tries to redeem it at the same time, there's not enough silver to go around. This is the same problem that banks have. If all depositors tried to withdraw their money at the same time, the bank would fail. Because banks don't keep all deposits in cash. They lend most of it out. They operate on fractional reserves. Silver ETFs operate the same way. They hold some physical silver, but they also have paper claims that exceed their physical holdings. And as long as everyone doesn't try to redeem at once, the system works. But if there's a crisis, if people lose confidence, if they all demand physical delivery, the system breaks. That's why physical silver is different. When you own physical silver, you own the actual metal. No counterparty risk, no paper promises, no dependence on the financial system, just you and the metal. Now, I know what some of you are thinking. This sounds like fear-mongering. This sounds like someone trying to sell me something. Fair enough. Let me give you the data. Let me show you the evidence, and then you can make your own decision. Silver inventories at COMEX, down over 30% in the past year. That's not an opinion, that's a fact. You can look it up, the data is public. Silver mine production, essentially flat for the past decade. Again, public data. You can verify it. Industrial silver demand, up over 15% in the past year, driven primarily by solar panel production. Public data from the Silver Institute. Silver-gold ratio, currently around 85:1, well above the historical average of 15:1. You can check this on any financial website. Physical silver premiums, running at 15% to 25% over spot price for retail products. Check any bullion dealer's website. These are facts, not opinions, not speculation, facts. Now you can interpret these facts however you want. You can believe that the market will somehow find equilibrium without a major price adjustment. You can believe that new supply will magically appear. You can believe that industrial demand will suddenly decline. Or you can look at the trajectory, you can see where this is heading, and you can take action to protect yourself. Let me tell you what the wealthy are doing, because they have access to information and advisors that most people don't. And they're moving money into hard assets, real estate, commodities, precious metals. They're diversifying out of paper currencies and paper assets. They're not doing this because they're panicking. They're doing this because they understand risk management. They understand that When you have unprecedented monetary expansion, when you have government debt at levels never seen before, when you have geopolitical instability, you need to protect your wealth with assets that can't be printed, that can't be debased, that have intrinsic value. Silver fits that description. It's a tangible asset. It has industrial utility. It has monetary properties. It's portable. It's divisible. It's recognized globally. And it's historically undervalued relative to gold and relative to its own fundamentals. Now let me address the practical question. How do you actually buy physical silver? And where do you store it? You can buy silver coins and bars from reputable dealers. Look for established companies with good reputations. Check reviews. Compare prices. Understand the premiums you're paying over spot price. For storage, you have options. You can store it at home in a safe. You can use a bank safety deposit box. You can use a private vault service. Each option has pros and cons. Home storage gives you immediate access but requires security. Bank storage is secure but gives you less control. Private vaults offer professional security but add costs. The key is to actually take possession. Don't leave it with the dealer. Don't keep it in an account where you just have a paper claim. Get the physical metal. Hold it. Store it securely. And here's something important. Don't put all your savings into silver. Diversification is still important, but having a meaningful allocation to physical silver, especially in the current environment, is a prudent risk management strategy. Let me paint you a picture of what the next few years could look like. We're in the early stages of a green energy transition that's going to require massive amounts of silver. Solar installations are accelerating globally. Electric vehicle production is ramping up. 5G infrastructure is being built out. All of this requires silver. At the same time, mine production is constrained. New discoveries are rare. Existing mines are mature. Production costs are rising. There's no easy supply response. Meanwhile, above-ground inventories are being drawn down. The silver that's supposed to be backing paper contracts is being delivered to industrial users. The buffer is shrinking. And on top of all this, you have monetary factors. Central banks printing money, government debt spiraling, inflation persisting, geopolitical tensions rising. All of these factors are driving investors toward hard assets. So, you have industrial demand pulling silver out of the market. You have constrained supply. You have declining inventories. And you have growing investment demand. This is a perfect storm. When this breaks, when the paper market can no longer suppress the physical price, when industrial users start panic buying, when investors start demanding delivery, the price adjustment is going to be swift and severe.